Welcome in, everybody. Thank you very much for joining us for our part one of our four-part series on our Index Universal Life Sales Academy. I, for one, not to try to sound like or try to geek out on this stuff, but I've been really looking forward to doing this Index Universal Life Academy to help you, as our agent partners, grow your business. Index Universal Life products have been out for a little over 30 years now. We've heard of whole life, we've heard of universal life, we've heard of term insurance as well. Let's get into the nitty gritty of the Index Universal Life product and why it's becoming increasingly popular in the life insurance marketplace. So today we're just going to scratch the surface. It's part one of the four-part series. So we're just going to be talking about Index Universal Life sales as a whole, talk a little bit about where it comes from, what it does, how it works, stuff like that. Parts 2, 3, and 4, we're going to get deeper into the Index Universal Life product and how it works. So we're going to be talking about how to position Index Universal Life and how to implement that into your sales vernacular. We'll talk about handling the IUL skeptic. There are times where I'm a skeptic on the product. I'm sure some of you are also a skeptic on the product. If we're skeptics on the product, you know that your clients are going to be skeptics. So how do we decipher between a good versus bad? We're going to get into that throughout this series, and then we're going to show you how Ameritas has a fantastic position within the Index Universal Life marketplace. I'd like to introduce to you our experts from Ameritas, Dylan Krings. He's the regional vice president, and his internal wholesaler, the backup, is Kevin Baytrip, who we're going to do a roundtable discussion about Index Universal Life products. And so we're going to have kind of a Q&A. If you do have questions, please type your questions. We'll get those questions answered for you towards the end of the presentation. And I will also provide my contact information at the end of the presentation. So first and foremost, Dylan and Kevin, welcome. Thank you very much for joining us, and thank you for supporting URL and our agent partners. So
thank you for having us.
Absolutely. Thank you, Matt. So we're glad to be here, and very appreciative of you guys having us on for this IUL Academy. So
yeah, looking forward to it. Here. And looking forward to your expertise. So not to get into the history of Index Universal Life, we've heard of Universal Life. We've heard of whole life. Kevin and Dylan, or Dylan and Kevin, what is an Index Universal Life plan in a nutshell?
I'd like to start, Dylan. Go ahead.
Sure. So, I mean, in a nutshell, everyone, as the name implies, life plan. So above all, it's a permanent life insurance plan. And then going further, as the name implies, indexed universal life. It is tied to an index in the market, such as the S&P 500, the Russell 2000, to a cash value component. So what it is, a permanent life insurance plan with potential for cash accumulation to use in retirement. Yeah. Kevin, what would you add to that?
Now, I would say this might be a little controversial because we all know kind of the history of IULs, but it's for the conservative investor. Now, it's not an investment. That is very clear from the IRS standpoint. This is a tax-free plan as long as it's not a modified endowment contract. Basically, you're getting into an index with a zero floor. So you can never lose, technically, without cost of insurance and whatnot, but it's a zero floor. So you can't go negative. You can only go up with a cap or participation rate, whatever it may be. So that's why I say it's for the conservative investor that maybe has some reservations about going directly into an index in the stock market. Get a life insurance plan with death benefit attached to it. IUL.
I like that. I like both of those definitions. It is a life insurance policy. And, you know, I never had somebody actually mention it as it's for the conservative investor. It's also, in my experience with URL, we have offered Index Universal Life plans and presented that for our agent partners for people who have already kind of maxed out their 401ks and their IRAs. They've already kind of maxed that out, and now they want to diversify and have another little nest egg going alongside of that. It's kind of that win-win as well, builds that cash value component, as well as it provides that life insurance death benefit. So that takes us to our next question. Can you explain the differences between a whole life policy, a universal life, and then what makes an index universal life that much more attractive for today's consumers?
Yeah. Kevin, you want to start this one off?
Absolutely, yeah. So they're pretty different in what you want from a goal for your client. So whole life, that's going to be the ultimate in conservative. You're not going so much of investments. You're trusting in the company to give you a dividend. We do that at Ameritas. You're essentially saying, I want guaranteed cash from this policy. So you're not going to have as high of a ceiling compared to an IUL, but you'll get that guarantee that you know you're getting something, and then maybe even a little cherry on top if the company gives you a dividend, which Ameritas does with our whole lives. Universal life, it's similar to a whole life, except it may not have as long of guarantees. So you're still working on company performance and current assumption interest rates, but it's just a life insurance policy that has a little less guarantee, going to be cheaper than a whole life. So that's where it kind of steps in there. And then for your clients that want more upside and are okay with just a little bit more risk than the other two plans mentioned, but they don't want to go in, like I said, directly into an index, that's where the IUL steps in.
Yeah, and Kevin, I think you hit it right on the head. The thing I would add on to that with those plans, and Kevin mentioned whole life has the guarantees, universal life, IUL, a little different, not the guarantees, the cost of insurance in each of those. So looking across the board, the cost of insurance, whole life, because of those guarantees, the cost of insurance will be the highest within a whole life plan. And then universal life and IUL, cost of insurance is going to be lower. So when you're thinking of permanent life insurance plans, if your client really wants the guarantees, whole life is there. They're going to pay for it for those guarantees. Lower potential, but IUL, you're going to have a higher potential for cash accumulation.
Yep. And understand, folks, that the cash accumulation avoids taxes. It's kind of like a tax shelter. I like the fact that Index Universal Life is cheaper than a whole life policy, and it still builds cash value, which provides that exit strategy. An Index Universal Life policy can provide death benefit protection during somebody's working years, and it can then supplement a person's retirement during their retirement years. That's how I've always explained it to a lot of people, the lay person. In our upcoming IUL sessions that we're going to be talking about here in our academy, we're going to be talking about how to design the IUL to be attractive for the consumer, the person, for that household protection, family protection, to get where they're building that nest egg while they're protecting their assets and protecting their family with the life insurance component of it. And then showing you how to develop an IUL for key person policies, buy-sell agreements, and for that business owner. So we'll show you that and how that can be an attractive policy for those people as well. I've been in the industry for and offline we were talking about this. I've been in the industry for about 25 years now, and IULs, when I first got into the business, was just starting to take shape. Now, fast forward, it is becoming increasingly popular year after year. We've kind of talked that whole life is the most expensive form of life insurance. Universal life doesn't have all those guarantees. Cash value component is not guaranteed. There's a lot of that fluctuation, and people find out 10, 20 years, 30 years that they don't have their insurance coverage anymore. Index Universal Life is becoming increasingly popular. Why do you think that is?
Yeah, so I'll start that one off. I think, Matt, you said it, it's a newer type of life insurance compared to other types. So people are hearing more and more about this. We're seeing more of this type of product sold. But I think it comes down to two things. People are worried about retirement income. Will they have enough in retirement? Are they saving enough right now or doing enough? to supplement it. So the IUL, it's a supplemental plan. It's going to help give them even more income or a different option for income in retirement. And then I think part two, taxes. Nobody likes taxes. If you can avoid taxes, everyone would say, yes, put me on that type of plan. As we discussed with the IUL, you can pay into this plan. And when you take the money out that you've earned or saved up through cash accumulation, you're getting it tax-free. So to me, those are the big two. But Kevin, anything you would add on to that?
Yeah, I think those are really good points. And then I'll just add just a consciousness in the consumer market. I would say there's a lot more knowledge around, I feel like, finances coming around. Now, the stats would say otherwise. We still aren't seeing that gap be bridged where we see a lot of people are still underinsured or not insured enough or don't have insurance at all. So we still see that gap, but I think people are becoming more aware, like we said, that there's going to be a retirement issue in the United States, especially with the birth rate going down and whatnot. There's not going to be enough people to pay for Social Security. So how are you bridging that gap? And IUL is a great method because, one, it looks more attractive than a whole life because it has that upside of the index. So that's why it's becoming more popular.
I like this. And this is a great way for people to understand that they're, again, providing that life insurance protection, protecting their income, protecting that paycheck through life insurance, because we buy life insurance or we buy insurance for our cell phones, that nice new high definition TV, cars, homes, but we don't. A lot of our consumers fail to insure what actually purchased those things: that home, the car, the toys, and that is their paycheck. And if they were to die tonight, some of that stuff's going to go away. Their family has a nice new shiny cell phone or a nice new car. If it gets in, it can be replaced if it's in a car accident, but you cannot replace you. So it does provide that life insurance protection. And to the point that we've made here, the cash value upside and a way for it to provide another form of savings for retirement. We know that Social Security is under the microscope every time there's an administration change in Washington, D.C. What's going on with Social Security? Well, this can give people a little bit of peace of mind knowing that they have another little nest egg there. They can sleep a little bit easier tonight knowing that their income is protected and they have a little bit of a retirement nest egg at the same time.
Matt, can I add something? You added something really quick, and I kind of remember this. Working in the insurance industry, as you know, it's a tough sale, but it also is one of the easiest sales for life insurance because it's not if, it is when. When that need comes, everyone has mortality. We are all going to die at some point in time. IUL just gives you an added layer of protection with cash accumulation that you can use during your life. So just wanted to add that. I got a piece and I, pass that along.
Yes, there is 100% probability that we are all going to die. Nobody leaves here alive. So good point. Yep. So there's a bunch of different companies out there that offer IUL. Some of them are just getting into the industry. Some have been in it for a long time. Not all IULs are the same. So what should advisors look for when they're determining a good IUL versus a bad IUL?
Kevin, I'll let you lead this one off.
I was about to say, Dylan, I'll happily lead this off. So a little bit of background on me, guys. I worked in brokerage and then moved to the carrier. So I worked at a company like URL for 3 years, and then I moved over to Ameritas. So I worked with a lot of these companies, and there was a specific reason why I chose Ameritas when I wanted to go to a carrier. It's because one of the strongest points, I believe, is that being transparent when it comes to IULs, that's how you know if you have a good one or not. That's the first point, because a lot of games can be played on the IUL, and that's also why it's popular. Is because there's a lot of games that can be played to make it look better, maybe get you a little bit more than what your client might actually return, and that affects the client. So at Ameritas, I like that we are transparent because you're 3 to 4 clicks away to seeing exactly what we've given a client in the form of credits on the indexes, and you can see our true history. I never got that from another carrier when I asked. It's 3 clicks away for you guys. That's a huge thing for us. And then there's also other stuff that I'll let Dylan take, but that's my spiel on it.
Yeah, no, I think that's a big point. So what I think Kevin and Matt have both said, IUL, this is most times, guys, your clients, they are doing this for a long-term accumulation cash play, typically 20 to 30 years. So having that long-term cap rate potential, not getting your cap rates cut in half 10 years down the road, that's important. You'll see some products have a very competitive story in that nature. Some products, they don't have a good background on that. They cut cap rates. So long-term potential on cap rates, number one. That's the biggest thing. I think another thing, the premium expense charge within a plan. You'll see that different premium expense plans can impact performance. So if you have a high fee on an IUL, more of your clients' premium dollars are going towards the cost of insurance rather than towards cash accumulation. So that's a big one. And I think just in general, some of the features and the riders that you will come across on IUL are a big one. I mentioned that it's a permanent life insurance plan, which is true. People are using it for retirement income. With many IULs, you can also use it for living benefits. So if the client gets sick with cancer, a heart attack, will that allow them to access their policy early? That's a big one. And then thinking of retirement income, many IULs today come with something called a lifetime income rider. So it's basically turning the life product into an annuity. It's a guaranteed monthly stream of income for your client that they cannot outlive. So little things like that, I think that's what's going to show you guys that you'll see makes a good IUL different from a bad IUL. But we'll dig into that a bit more over these next couple sessions.
Absolutely. Let me see here. Before I get into that next question, one of the things everybody on today's call, there is a link that we have added where you can download a PDF or a link to an article that was written by Ameritas, which is the 7 critical red flags to look for with index universal life plans. So look for that link there, 7 critical red flags to look for, and it'll show you how you can determine a good IUL versus a bad IUL. And I do see some questions coming in. We're going to get to those questions, so hang tight, everybody. Before we kind of wrap this part 1 of the 4-part series up, what are some of the key takeaways that an advisor should know that as they're getting into index universal life sales?
Yeah, so I'll kick it off. I think the big one here, guys, to really know, and as we've discussed, IUL, it's going to be used mostly for supplementing retirement income. So the big things for you guys to know when designing the plan, number one, make sure it is a non-MEC, so a non-modified endowment contract. This is going to make sure the client is not taxed on money they take out later on in life. And then with IUL, what's nice, it's flexible premium. So there's a range of what they can pay, but we recommend at Ameritas, the client should be paying at least the target premium or max funding it. So that's going to make the biggest difference on an IUL. So as you start to design these, make sure you're paying attention to that on the illustration, how you're setting that design up. I think the last thing I'll say, do not judge a book by its cover. So you guys have heard that saying before in your lifetime. What I mean by that, do not judge an illustration simply based on the numbers that you're seeing. There's 100 different IUL products in the market. It's important to really understand the product, the long-term performance of that product or of that company. And I think that will guide you to at least a few solid options. So again, just do your homework, become familiar with the plan. And if you guys need help, I think URL, happy to help. Ameritas, also happy to help on anything from our product perspective. But Kevin, what would you say for that?
I would say looking more into IUL policies themselves instead of just overarching. I'll say the first thing, cap rate management. That's the biggest thing. You may have a shiny cap that's really high, 13, 12%, whatever it may be. But if it doesn't stay that way over a long-term time, it doesn't matter. An illustration is just like driving the car off the lot. It's not going to be the same value the day after. So you really need a company that's going to perform for you a long time. That's what Ameritas does. And then also, when you're looking at IULs in general, you want to look at the included riders and then any additional riders that you can pay for. But the included riders are really what sells it, because IULs, at a nutshell, if you run them all apples to apples, most companies fall right in line with each other. $300 to $500 difference in income usually, when you take away all the frills and stuff that people do. So what do they offer you besides just cash value or death benefit? Is it living benefits, lifetime income rider, all of that stuff? Look at the riders. And then finally, just making sure that you're meeting the client's needs, because sometimes the IUL isn't always necessary, and putting them in another product would help. So don't be tied just to IULs. There are other products as well. That's what I'd say.
Kevin, I'm going to add one thing on. I think you mentioned it, talking about illustrations and performance. You guys will see several different illustrations in the industry. Some products will illustrate at 5% of return rate. Some will be at 6%. If you really want to try to do an apples to apples comparison or make it similar, match up each IUL illustration to the same percentage. So that's just going to give you a bit more of a clear picture. How will this product maybe compare or perform in the long run? So that way you're not working with differences in performances on different illustrations. But Matt, I'll turn that one over to you for anything you might want to add.
Yeah, that's a good point, because when I'm comparing the different carriers, and I know that some of our brokers, some of our partners, they will run their own illustrations. And one of the things that they may not realize is that some of these companies have these pie in the sky returns, 5, 6, 7%. And, if you want to really kind of compare it apples to apples, you do have the ability to toggle that interest rate down to a more realistic level. Now you're able to actually see apples to apples comparison. So make sure when you're running an illustration, if you're not doing it, ask me. I'll be happy to show you a side-by-side apples to apples comparison, so that you see the performance between each of the carriers, and you'll see who's going to shine and who's not. So good points there. Now, in part 2 of our Index Universal Life Sales Academy, we're going to be talking about how to position IUL plans for family household protection. We're also going to talk about how to position IUL plans for businesses, business owners, for key person, for that buy-sell agreement. And we're also going to show you how to make a compelling case to your clients on why they should consider an Index Universal Life policy to protect themselves, protect their family, protect that retirement. So stay tuned. You're going to be getting emails. You're going to be seeing links on our website at URL insgroup.com, so that you can register, if you haven't already, for part 2, which is taking place 2 weeks from today. We'll be doing our next part 2 of our 4-part series. If you have questions after we've parted ways, feel free to contact me. My direct number is 717-216-8041. 717-216-8041. Email is matta@urlinsgroup.com. Guys, we had a couple of questions that have come in while we were talking. The first question here comes in. Let's see here. This is a question. I could probably handle this one. It says, I have a bit of a controversial question. Why does Dave Ramsey not recommend IULs? And I'll tell you from what I know about Dave Ramsey, and if you've been in the business as long as I have, and maybe even longer, you've probably heard of the old A.L. Williams buy term, invest the difference. We've all heard that, right? Here's the sum and substance of it. So Dave Ramsey and some of the people that he knows within the financial world, he basically is showing people how to invest their money in mutual funds, stocks, things like that. but a lot of people don't have the discipline to invest the difference. They'll buy a term policy, but they don't invest the difference. With an IUL plan, it still is life insurance protection, but it's also using those premium dollars for and using it as an investment component. That's why Dave's in that old mental, that old thought, that old training of thought or old school of buy term, invest the difference, because that's kind of what was pounded into his head and so on. So all an index universal life policy does is it helps your client invest the difference. They don't have to babysit 401k, a mutual fund, and the investments. I was asked, where are the 7 questions articles? It should be in the one of the links there for handouts. You should be able to get that there. If it's not there, if you can't find it, please email me. I'll be happy to forward that link over to you for that. Again, my email address is matt@urlinsgroup.com. Another question is, what is a realistic rate to compare against? Is it 5% average rate of return? Is it 6%? What would you say is a good realistic number for quoting on an IUL plan?
Yeah. Kevin, I'll let you take that one.
Yeah, industry standard has always been 5. It's a very safe number. You feel very confident reaching that. In most companies, the reason why you run that isn't so much that you believe you're getting that rate of return. You're stress testing the IUL to see those expense charges. So something that runs at 7% almost, of course it's going to look good compared to a company like us where we run at 5.92. But if you stress test it down, put it at that 5, you really see where the policy starts to crack.
Absolutely. Is there a policy review training for IULs? That's a good question. Does Ameritas offer any type of worksheets, any type of software that if somebody already has an IUL, maybe they've had it for 5 or 10 years and they want to see if there's something better out there? Does Ameritas have any kind of tools or resources for that?
Currently, not that I'm aware of. I know we're looking at coming up with a few other materials. To Adrian's question, one thing we do have on the Ameritas website, very simple. If you guys just write this down, if you log on to the Ameritas website and click Learning Center at the very top, and then number 2, click Training, you will see a surplus of materials, different information on IUL. So it'll be a review. You can get into the basics of IUL. You can get a little more in depth. But at this time, we do not have a specific tool for in-force IULs.
To Adrian's question as well, URL does have worksheets that you can use. They're non-denominational, where you can look at the cash value, premiums, death benefit, all of that stuff. You can, just so you have that, then you can contact me or one of my team members here at URL, and we can run the numbers for you and see if they're good at where they're at, or if they might want to consider moving their money or making that change, maybe doing a 1035 exchange. So we do have some worksheets and things like that. And we've also done some trainings in the past on policy review, and it's something that we can certainly bring up again here this year. We're into doing different trainings and stuff like that, very similar to what you're experiencing right now. One of the questions that also came in, and I don't really have an answer for this, and I'm not sure exactly where this question is going, but it says, why does a UL, Universal Life, have a higher risk of terminating the insurance coverage with age rather than with an index universal life? I'm guessing it's because of the nest egg, that bucket of cash that's helping offset those increased costs of insurance. Anything to add there?
I would add just with current assumptions, everything I've worked with before, they're lower interest rates, rate of returns that you're seeing. So it's going to naturally not be able to keep up with the cost of insurance when it's priced out a certain way. But again, you're trusting ULs are typically going to be company based, how they're managing their money. Ameritas manages their money really well. We have an 11% capital to surplus asset ratio. So we're really sitting pretty. But if you have a company that maybe isn't able to reach that, ours is 3.6, we're pretty comfortably going to reach that. But if a company has a current assumption of 4.6 or 4.7, it might be more difficult and you're going to see those laps typically. And that's why the IUL looks better, because you can illustrate a whole 100, 200 basis points above that. So naturally you can show it look better.
Yeah. Yeah.
Yeah, but I'll just add on to that. Earlier, I mentioned premium expense charges on plan. What also matters, long into the policy, especially as the client gets into their 60s, 70s, 80s, that cost of insurance increases. They're getting up there in age. But working with companies that have a strong history of not increasing in-force blocks of business, the premium expense or the cost of insurance on those older clients, that will also be a big difference. Ameritas, proudly, we have a strong history of not increasing the cost of insurance on our in-force business. So strong story there, but some clients see their IULs, their universal life policy lapse because that cost of insurance increases and they don't have enough money in the plan to back it up. So that's a big reason.
Yeah. Folks, we're in our future sessions, we're going to also be talking about terminology. What does participation rate? What does floor mean? What does a cap rate mean? All of that terminology, so that you are familiar with it and you can also speak intelligently about the products with your clients, and that way they understand, you understand, and everybody is making an informed decision. That's all the questions that we have for today. I appreciate everybody's time. And I think, Kevin, you had one other thing to mention?
One last thing. I do want to mention about the Dave Ramsey thing.
Yes.
So his mindset can work for younger people, and that's kind of what he goes for. But that same methodology with term and invest the rest with older clients, they don't have as much time. If the stock market has a big dip, they can't make that back up. He is accounting for the clients are young. They're going to be financially dependent and strong and, get that term and then invest the rest, which we know isn't always the case. But they have time if the market goes down to make it back up with the averages. With an older client, getting an IUL makes a little more sense because they don't have that same time frame. So having that 0% floor where you can't go negative, that's where you can actually step in and make quite a bit of difference. And that's where I think his philosophy just kind of falls flat with that group.
Yep.
That's all.
I like that. I never thought of that. His target audience is much younger. They have 20 or 30 years to make that loss up, where, somebody that's going to be in the workforce for maybe another 10, 15 years, it makes more sense to get that IUL. So good point there. I appreciate that. It's great insight. So yeah, I appreciate everybody's time today. If you have any questions, if you need me to send you that link, call me, email me. I'll be happy to get that over to you. 717-216-8041, matt@urlinsgroup.com. Stay tuned for part 2 of our Index Universal Life Sales Academy. That's going to be taking place. Look forward to seeing everybody at that next meeting. And until then, be safe and have a great day. Take care, everybody.
Thanks, everyone.